This is your LMAX exchange technical update for Monday, April 24th, 2017. Euro dollar. So the euro has finally broken out to a fresh 2017 high, just squeaking above that previous 2017 high that we had seen earlier several days back, going back to the 27th of March. The break does open the door for the possibility of fresh upside in the weeks ahead that could take us up towards 114 to 115 as the market confirms a higher low now at 105.70 above that previous 104.95 higher low, opening the door for that measured move towards the 114 to 115 area. However, much like was the case with the pound in the previous week, we need to see how the market responds on this break above 109.06, that previous 2017 high. Inability to really establish above this level would still keep the pressure on the downside, while a push back through now does open the door for a fresh upside extension towards 114, 115, confirming or strengthening the prospect for a longer term base now in the euro. Sterling dollar. So cable is consolidating off its recent highs after breaking out to fresh multi-day highs above the previous resistance at 127.75. The breakout does suggest the market could be in the process of forming a longer term base now, seeing a structural shift that opens the door for the next measured move towards the 135 area further up. Look for any setbacks to be very well supported into the 125 area, with only a break back below recent support at 23.60 to put the pressure back on the downside. Dollar yen. So dollar yen has seen a nice rebound from recent yearly lows, with the market pushing back above 110. But overall, the pressure here remains on the downside, especially after the market broke down below a multi-day range that was seen between 111.60 and 115.60. And so any rallies now should be considered corrective in favor of the next lower top, ideally well ahead of 1220, in favor of the next downside extension back towards that measured move at 107.60 and potentially below. Only back above 1220 would compromise the bearish outlook. Euro Swiss. So Euro Swiss has seen a very nice bounce into the new week, though overall the market does trade within a broader downtrend and has come into some key resistance above 108. The market continues to show signs of stalling out above 108, and while it holds below that high that we had seen back in December at 109, the risk remains tilted to the downside, with rallies still seen well capped ahead of what could be a resumption of declines. Ultimately, though, the market would need to break back down below the 2016 low at 106.24 to continue the downside pressure and expose a deeper drop towards 104. So right now, 106.24 below and 109 above are the key levels to watch. Aussie dollar. So Aussie has been showing signs yet again of topping out as it rallied up recently towards 78, which has been a critical resistance point for the currency. Most recently, the market has stalled by that 2017 high at 77.50 ahead of this latest round of setbacks reaching 74.75 thus far. Any rallies therefore should be well capped over the coming sessions, with a breakdown below 74.75 to strengthen the bearish outlook and accelerate declines potentially towards 70. At this point, only back above that 2017 high at 77.50 would delay this outlook. Dollar CAD. So dollar CAD continues to retain a highly constructive outlook, with this market being very well supported into dips in favor of higher lows and higher highs. The most recent dip was supported at 132.24. That was the low that we saw back on the 13th of April, and a fresh upside extension is now seen through the multi-day peak going back to December of 2016 at 136, above which would expose a measured move towards the 140 area. Only back below 132.24 would compromise this outlook. Kiwi dollar. Kiwi is showing signs of a major top after stalling out in 2016 ahead of 75 and then in 2017 ahead of 74. The market continues to show signs into the second quarter here, with the market now consolidating just above 70. Any rally should be very well capped, ideally now ahead of 72, in favor of the next downside extension below key support at 68.62, which would expose a drop towards 65. SPX 500. The S&P 500 continues to consolidate just off record highs, and although we have seen some setbacks in recent trade from those record highs, while the market holds above 2320, these are minor setbacks ahead of what could be a bullish continuation through the record high that we saw back in early March, just over 24 and towards 2500 further up. At the same time, if the market does stall out up here over the coming sessions and opens the door for a breakback below 2320, a break below 2320 would be a significantly bearish structural development, opening the door for a significant top and exposing fresh downside towards the 2270 area as an initial downside objective. Gold continues to show signs of bottoming out since 2016 after stalling just shy of 1100. The market has been putting in a series of higher lows and higher highs, most recently breaking above the previous 2017 high at 1265 to confirm that next higher low at 1195, opening the door for a measured move in the days ahead towards a measured move at 1335, just shy of the 2016 high at 1375. So with that said, any setbacks that we do see now should be very well supported, ideally into the 1230 area for that next higher low, with only a breakback below 1195 to compromise the bullish outlook for gold.